guys, that is the 15-minute break conclusion. We will now be getting back to page 443. 443 in the workbooks is progressive exposure. After this, we will take a 5-minute break. This section should last just about an hour and 15 minutes. So let's get back to Mark and Mark for progressive exposure, page 443.
Okay, welcome back. We're going to move to page 443. We're in the risk management section in the second workbook. I know there's been a lot and it may be overwhelming, but bear with us here. There's still a lot more as well. But again, these are things that you really not only you need to know, but you need to study and you need to work on. And this is really what it's all about. This section really brings it down, and we're using a lot of examples to illuminate points in many different ways to hit you from every angle. So we really make sure that you're getting this. And because sometimes one way we say it, one person understands it, but then you got to say it a little bit differently or show a different example, different metaphors, and so forth. What we're going to get into now is what we call progressive exposure, and also having you understand that trading is not an on or off business. It's not just a green light on, red light off, where the market's, it's a buy signal. I know we get into these buy and sell signals that, we've got these services and these indicators and so forth, buy, sell, but there's a lot of there's a lot of gray area in between, and what we found is the best way to trade is to trade incrementally, and we're going to show you what that means. And also, this is a big part of managing risk. So the first thing you want to always realize is that you should always think in a small success leading to big success, meaning that let your smaller trades give you the direction as to where you should go with your larger trades. So whenever I get back into the market, and again, this is a perfect example. You're in a tough market, you're in a bear market, and I'll just ask you, Mark, if you're in 100% cash and you're in a real difficult market, and maybe you haven't been doing that well, or you've been out for a while, all of a sudden you start seeing some VCP setups. Are you coming in and just going hog wild and putting your whole account in a couple stocks and taking big exposure right off the hop?
Absolutely not. The idea obviously being, which we're going to get into in this section, but, you have to jockey for position and gauge the health of the market and by sticking a toe in first. It's the same old analogy of, do you want to just jump in the deep end of the pool without checking the temperature of the water first? That's a recipe for volatility in your returns that you don't want if you do that. That's sort of the cowboy mentality, where the real professional mentality is to start at the other end and test the waters first, and only really get aggressive when you feel like the timing, and everything is correct, which we'll get more into.
Yeah, and taking the temperature is a great a great metaphor or analogy of taking the temperature of the market, taking the temperature of your strategy, of whether things are working or not, the stocks are breaking out. And remember, we want to look for those confirmations, violations. So when Mark or I go back into the market, even David Ryan would tell you the same exact thing. Bill O'Neill would tell you the same thing, that we're gonna take a few small trades and start off with some smaller exposure. Usually I'll go in with about 25% exposure, will be sort of my first toe in the water. It may be 25% position, and maybe 5% positions, depending on what I'm seeing in the market, if there's a lot of stock setting up or not. But I'll put that proverbial toe in the water and take the market's temperature. And this also works mathematically. I'm going to show you how the math works. And this is what we call financing risk. We're always looking to finance risk, improve our worst case scenario, and always maintain mitigating that downside. So again, when you first go into market, it's all risk. You have no profits to work with. You don't have any cushion. It's all risk. So you incrementally want to move yourself into the market. And So let me show how this, let me give you a few hypothetical examples of how this would work. So say your first trade, you've got a 4% stop, okay? And it represents $1,000, right? And so you're a 2-to-1 trader. We're just going to use 2-to-1 and say on average, you're 2-to-1. So if you had a winning trade, it would average 2,000. So we'll say that you made $2,000 on this trade. It was a winning trade, right? So now you've got $2,000 that you've banked, and you've now financed 2 more trades. If you went and used that same risk and you backed into another trade, and say another trade comes out of a VCP and you use a 4% stop, well, now if you lost in that trade, you would lose $1,000, and you still have $1,000 for another trade. So you're financing your larger size, or you can double your size. If you doubled your size, now you would, if you lost on that double size, you're going to be right back to where you were, no loss in your account as far as from your starting capital, your principal, and you've financed a larger amount of risk. Like I said, this is what we call progressive exposure. And this is something that Mark and we do just axiomatically, automatically. We'll constantly gauge by using test positions. Now, once we get some feedback and trades are working, then you can jump to larger positions and you can start trading at a larger exposure. But here's the thing that you have to remember, and again, this works in the opposite too. Okay, Mark, if trades start going against you, let's just say you came in with, I don't know, 10% position sizes, you took a couple of them, and you get a bunch of losers in a row. Now what are you doing? What are your next trades going to be?
Smaller.
Yeah,
absolutely. I think of it, in terms of, just like we talked about those sliders before. It's a sliding scale in terms of that feedback in the market telling me, either more aggressive, more conservative. So if I come into the market and get whacked, I'm not coming back in with the same size. Because again, even on a portfolio basis, I want to wall off that left side in terms of the drawdown. So if the market is, I know the criteria is good, but I'm losing, I know the market is bad. The only thing I can control, is my sizing at that point.
Right. So let me give you another example here of how progressive exposure works and how you would scale yourself up, and then you would even scale yourself back down. So now let's just say your position size, your maximum position size that you're willing to risk would be 25%. 2-to-1 trader, that actually is your mathematical optimal position size, would be 25%. So that would be where you're trying to get to. You're trying to get to your bigger positions being 25%, but you're just getting into the market. So you take a quarter position, right, which would be 6.25%. You risk $500. Okay, but that you win. You win 2-to-1. You make $1,000 on that trade. All right. Now you can bump your size up. Right, you double your size to 12.5%, and you're risking now $1,000 because you've doubled your size. Well, let's say you get 2 trades in a row that are winners, and that's now a $2,000 because you risked 1,000, 2-to-1, $2,000. Right, now you've got $3,000 profit. You can now move up to that full position, and even if you lose, you would still have $1,000 left over and be able to move to a half position, which you could scale back down. Now that things aren't working, you lose on your big trade, you can scale back down if you'd like. Even if you kept it the same size, you're going to lose less than you originally risked, because now you've got $1,000 more to work with. So this is how you would expose yourself. Now, the reason why you do this is because you want to pyramid yourself into trading your largest when you're trading your best, and always be guaranteeing yourself to be trading your smallest when you're trading your worst. And the only way to do that is to bend with the market, is to bend with the results. So when things are going well, you step it up. When they're not, you bring it back. What happens is, yes, sometimes you bring it up and then things go bad, and you bring it down, and then it starts going well, and you wish that you did the opposite, and you got really aggressive when things are bad. You can go back in hindsight and Monday morning quarterback. But the bottom line is that outside of that noise and those short-term back and forths that you're going to, as Mark said earlier, jockey for position, you are going to guarantee yourself that when things are going really well, you're going to be having big size on, and you're going to be making big money in the bull market. And when you go into the bear market, you're going to guarantee yourself that you take your size down until it's negligible, and you are going to be in cash or near cash, and you're never going to get yourself in trouble. And this is the reason why I participated in every bull market in the last 9 bull markets in 30 some odd years, and I've never been caught in a single bear market, not one single time, having heavy exposure, because I bend. I progressively expose up and I progressively expose down. Mark, in the years, the 13 years that you laid down these great returns, have you ever been caught in a big downdraft, even one single time?
No, for this reason, and I think this is really, just go back to that last slide real quick, just to make it really simple, because one question we get is, well, why not just go in big right away? You're going to be there, you'll eventually be there when things work, and well, that's true, but the reality again is these periods are not evenly distributed. And so if you think of it in terms of, if you're a 50-50 trader, it's not always win-loss, win-loss. You have these runs of wins and losses, and you want to use that to your advantage. So if you look at it, in this case, if you use progressive exposure properly, and one trader does exactly like the slides here say, trade 1, 2, 3, versus just starting at trade 3, risking $2,000, who's going to wind up? They're both going to be trading big. It's going to take the one who does it in order a little bit longer, but they're going to be risking a quarter in order to finance the ability to get there, versus the other one who just goes in big every single time. And the volatility in their trading is going, again, to the point we were saying before. You would think there's this massive difference. It's often smaller than folks think, and learning how to do this properly. And I've heard many of Mark's students over the years say that this lesson has made the biggest difference in the long run in their trading, understanding
Yes.
and learning how to do progressive exposure properly.
Yeah, in almost all the cases of all the really successful traders that we've trained, progressive exposure is always mentioned as one of the main things that changed their that made them successful and changed their trading from being mediocre to being outstanding, is understanding this and applying it. Now, a couple of things I want to say. Again, starting, as Mark said, starting right out and coming out with big positions. Well, you can, in hindsight, in this example, yeah, that would work. But what if those first couple trades, or all 4 of those trades, were losers? Now you're in the hole. And this goes right back to the previous example of losses work geometrically against you. So what happens when you get into the hole and you're down 20%? It takes a 25% gain to break even. If you're down 50%, it takes 100% gain to get even. So now you're allowing the losses to get you in a hole, and now it's going to take you more work to get out of that hole. That's why you have to protect the downside. You can't go into the hole too deep, or it's going to take much more work, because losses have a bigger impact on you. So that's the real reason, is because losses work geometrically against you, and that's why you have to mitigate the risk up front. Yes.
And you brushed over this briefly, I think, in one of the previous slides, the idea of always trying to improve your worst case scenario. I think people have to really think through, what does that actually look like in practice? Well, this is what it looks like right here, because the worst case scenario is you just get clobbered on trade 1. Or maybe you go into 4 trades and then wind up losing. Well, who's improved their worst case scenario? If you use this progressive exposure and you get hit on the first trade versus coming in with big size, you lose a quarter the amount. And if you scale up properly and then everything gets hit, your P&L is at 0, where somebody else is now negative. That's improving the worst case.
Another great point, Mark, and that leads to something that is really important to point out, is that what we're doing, not only do we always want to improve our worst case scenario, but we want to improve our potential. We want to increase the potential for reward. So as Mark, what he's saying here is that we're increasing our exposure, but while at the same time reducing our risk. So we're creating asymmetric leverage. and moving ourselves into a situation that is low risk to maintaining a low risk downside, but increasing the upside. And
that's a gold mine, not just a gold nugget right there.
It is. It's everything. It's the whole ball of wax. It's what it's all about. Let me show you another example here. And this is where financing, where as you use progressive exposure, you're financing your future trades. As I said, small success leads to big success. And what you're trying to do is create profits, so then you can increase. You want to increase your size. That you want to get to when the market's good. You want to increase your size. That's what differentiates the great traders from everyone else. Is that someone like Mark, myself, when we see the whites of the eyes, we're unloading the mag. We're putting the pedal to the floor, and we're making lots of money when times are good. And that's we don't have to have very long good times because we're getting so aggressive at that time, but we're never doing it just haphazardly or taking a lot of risk. We're always doing it on the backs of prior success and financing that risk, those bigger positions. So here's again how it would work in real life, where let's say you do have a market that's improving and you start off with a small position, you make a profit, you make $1,000, you bump it up. You bump your position size, your next size to 12.5%. You double it. You get another profit. You double it again. Now you get a little win streak. You got 3 in a row. Well, what you just did is you just financed by going from 6.25 to 12.5 to 25%, and very incrementally and slowly taking small risk to larger risk and financing it the whole time. You're only at real risk of principal on the very first trade. You've now financed 3 full positions and a half position. You can and you could take those one at a time, or you can go into almost a fully invested position. Now you've just financed an 87.5% a total exposure with 0 risk of original principal, and now you can get very aggressive. And again, if you get hit on all those trades, you might lose on all those trades. You go back to break even. But see, you're never going in the hole where you have to dig out of that hole. And this goes back to one of the chapters in my second book, where I say you want to compound money, not mistakes. This is where you improve your worst case scenario. You lever yourself up to taking larger size and having higher potential, but never with taking more risk. This is really what professional trading is all about. So we want to let profits finance our risk. So we start with relatively small positions. These are what we call pilot buys. And these act as a couple things. One, we're trying to build up some profits, so we now can use those profits to finance the larger risk. But we're also getting the feedback. We're getting feedback from the market, and as Mark said, we're taking the market's temperature. And that's letting us know if we should even indeed get more aggressive. We're not going to just get more aggressive just because we took a trade. We've got to see that the strategy's working, the breakouts are working, the market is rewarding our strategy right now, and we're not going to get aggressive unless we get that feedback. All right. So once we do get that feedback, now we've got the profits to finance the larger risk. So, and this goes back. A lot of these things will go back to Bill O'Neill or David Ryan and I talking about these in previous master trader programs and in my books. If you're not trading well at 25% or 50% exposure, and the trades aren't working, why in the heck would you ever bump your positions and your exposure up? Why would you ever go to 75% exposure or 100%? If your 6.5%, 6.25 quarter positions aren't working, why would you ever put on a full position at 25%? Unless you're a glutton for punishment and you want to argue with the market. But this is precisely what people do. They revenge trade because they start off with these big positions, they get themselves into trouble, and then they want to get it back too quick. And before you know it, that chart that is so basic and so remedial of losses working against you is everything. It's everything. When you get yourself in the hole, now it takes way more work to get out of the hole. All right, let's move on to talking about the priorities, because when you first get into a trade, what this is basically bringing us to is that your first priority in a trade is to manage risk as and mitigate it as much as you possibly can, because it's all risk. You don't have any profits. You have no history of success. You have no feedback from the market that trades are working. So it's just all risk on the table. So you want to mitigate that as much as possible. You do that with position sizing and your stop loss. But now, as the trade progresses, all right, and the trade becomes profitable, well, now your priorities shift, they change, and you have the option to change your priorities. So now, as the trade starts becoming profitable, at some point, now you want to start protecting your break even, because now the trade becomes risk free. If you protect your break even, and the worst case scenario, this is what Mark was just talking about before, improving your worst case scenario. You want to always look to improve your worst case scenario. Now, if you do it too quick, you choke the trade off, right? So you can't improve it too quickly. You got to give the stock some room, right? The stock, you're setting an 8% stop. Well, until you get a decent profit, you're going to stick with that 8% stop. But now let's just say you're a couple times your risk, all right? Well, you don't want to now take a nice profit that you've taken the risk, you've given the market its shot at you, and taken that risk, and now you've accomplished the goal of making more than you've risked. Well, now at the very least, you want to protect your break even. So now if you do play it for a bigger move and it turns around on you, you're now not taking a profitable trade, turning it into a losing trade. So now that's your next priority. But then let's say you're fortunate enough to have the trade move up even more, and now you really start getting a nice, really decent profit. You're a good multiple of your risk. Maybe you're above your average gain. Mark, if our average gain is 10%, and we go into, on my next trade I go into, and the stock goes up and it's up 15%, what does that do? If I sold that, what does that do to my average gain?
It improves it.
Right. And that's the goal, right? The goal, remember, again, everything we talk about previous, we're building upon. The goal, if you remember, is to get an idea of what that average gain is and optimize it. Get that average gain as large as you can. All right. On average, if you can have 10% gains on average, well, if Mark averages 15% gains on average and I average 10, and we're both 50% right, and we cut our loss at 5%, he's going to do better than me, right? So we want to improve that. The only way to improve that is to take profits above it. So now that is your next metric, where now as you start to get above your average gain, you've got a multiple of your risk. Let's just say you're 4 times your risk, right? You risked 5%, you're up 20% now, but your average gain is 10. Well, now you're 2 times your average gain and you're 4 times your risk. So now you want to go into your priority changes again. You go into the profit protection mode. Now instead of protecting your loss, which you start off protecting a certain amount of downside, then you protect your break even. Now you're going to move up and protect your profit. And this is where a lot of traders go wrong. They'll get a decent profit, but then they'll let that profit come all the way back down, and in many cases turn into a loss. And that's a cardinal rule, which we're gonna move on to right here, is never let a good size gain turn into a loss. Now, good size, decent is a relative term. Depending if you're a day trader, a good size gain might be 2%. If you're a long-term investor, it's going to be a lot larger. When you get above your average gain, and especially if you're multiples of your average gain, you're at a decent gain because it's improving your numbers. That's moving the ball in the right direction. That's getting the ball down the field and getting closer to the goal line, which is to optimize that average gain. So as you get above that, that's where you don't ever want to let that turn into a loss. You really want to protect it and not even really, let it go below your average gain. But that might be a little tight. If you're up, 12% and your average gain is 10, that's not a time to be protecting your average gain, maybe because it's so tight, it doesn't allow for much fluctuation. But you're up 30%, you certainly don't ever want to let a 30% profit turn into a loss. I mean, Mark, do you ever do that? I mean, would you ever let a 30% gain go into the losing column once you're at a 30% gain?
No, I don't believe I've come to my knowledge. I can't think of a time that's ever happened. And the way I often think about it is the more extended I get from that average gain, the more I don't want to let that dig back against me, or the more I'm going to start potentially either taking pieces of the trade off, because as Mark was saying, that's what's going to improve, or in my case, over time, sustain that really good average gain, and keep that relationship intact, where, I often will sell a piece and then move the stop up sort of in combination to make sure and ensure myself that I'm not going to let that come back too far against me.
Right. Now, we've shown you a lot of tactics and given you tools and charting and so forth. But a big part of this, probably I'd say the most important part, is changing the way you think, changing the way you look at trading, losses, the math, and what you're aware of, your awareness just as in general, of what you're going to look for a stock and your selection criteria. But I'm going to give you some tactics here, or techniques, some position management techniques. But there's a million ways you can do these things. There's all kinds of permutations. All right, but it all comes down to the mathematics behind it, and improving your worst case scenario, creating what we call asymmetric leverage. This is a term that Larry Height loves. He always talks about asymmetric leverage. We've had so many conversations about creating asymmetric leverage. And this is what very successful traders are great at. All right. They're not just great at finding charts and breakouts. That's sort of just first base, to find the charts and to have the skill to be able to see a pivot point. Almost anybody can do that. But doing this stuff requires discipline, awareness, work, self-reflection, study. These are the things. This is why everybody doesn't do this, because this is the stuff. And I'm going to show you a couple things here. We're going to talk about a few techniques here and a few ways of looking at trading. And then from there, I think it'll open up the options that you'll have going forward. So there's not only do these techniques and tactics protect your math and your profits and create the asymmetric leverage, but there's another thing that you have to protect, and that's your confidence, especially when you're new. Because if you go into the market and you start getting torpedoed right away, you're like, this strategy sucks, I suck at it, it's not working, and you'll abandon it, you'll quit, you'll change. So you're always protecting your confidence too, because you got to have the confidence to go in there, to be able to have the conviction to, when you do see trades working and things are working well, you go in there, take those big position sizes, and you make a lot of money. And when things aren't going well, you cut those losses, and you have the conviction to do that, to do that effectively, and to move up in size. Mark, you started off trading, few, small lots, tens of thousands, and now you're trading tens of millions. So, I mean, the pressure that comes with putting on a multi-million-dollar position is obviously much more than buying $10,000 worth of stock, right?
Well, in terms of dollars, maybe, but that's not how I think about it at all. Because to, your point in terms of confidence, when you are, again, in a situation where your confidence is intact because you're doing all these things properly, I don't want to say the dollars become irrelevant, but that impact is very minuscule in terms of what it has on you, because you know what to expect, what the amount of risk you have, and everything is acceptable within your metrics, and then the overall risk to your portfolio.
And you went right where I wanted you to go. And that's why Mark Ritchie's Mark Ritchie. You see, because I knew he would say, well, not really. I'm taking big positions and it's not freaking me out, because of all these steps, and all this risk mitigation and all these techniques and tactics. You see, his confidence is intact. He's able to take these big positions, but a lot of people aren't. They start off trading, and then as the trading gets bigger, all of a sudden, all the decisions change, because now that dollar amount, now they got a $10,000 profit. Instead of just equating it percentage wise, they're thinking what that $10,000 buys, and now it's affecting them emotionally. And this is where all this, having all these tactics, understanding the math, having all this understanding is what creates the discipline, is what creates, and the tactics is what creates a great trader that can grow. Because to make a lot of money in the market, you obviously got to grow, and you've got to be taking bigger and bigger size. When I first started, I was buying 5 shares, 10 shares, 50 shares. 50 or 100 shares was a big position, and I was buying $4 stocks, $10 stocks. Now today, I there's times where I take a $10 million position in my personal account, which, and to some people that's small. There's people, there's investors out there that take $100 million position with the same type of calmness and certainty that they would if they're taking a smaller position. How do you get there? Rules and having the tactics and being able to plan for the worst case scenario, improving that worst case scenario. So, all right, I went enough on that. Let me show you some of these tactics. So the first thing, and what I just sort of automatically do, if I get unsure, if the stock starts moving against me and I think, I should sell here for whatever reason, I usually just sell half. If the stock goes up and I'm at a big profit and I'm like, man, I really want to take this profit. I think it's going to go higher though, but I'm really just torn. I usually just sell half. And the reason why is because selling half is a psychological win-win. Regardless of what happens, you are right on both sides of the trade later on, after you make that decision. So if I sell half, if it goes up from there, I say to myself, poof, thank God I held half. If it goes down, I say to myself, whoa, thank God I sold half. Either way, I'm equally psychologically, protected, if you will. Now, if I sold 75%, I would be more wrong than right in one direction or the other. But when you sell half, you're equally protected regardless of what happens. So it's sort of a middle road. Okay, that's sort of the starting point that I want you to understand, of just putting yourself in a psychological win-win. Now, once that stock goes up, the next way to put me into a good psychological position is to then move my stop to break even and free roll the trade. Free rolling just means that you are now risk-free. You've de-risked the trade by moving your stop. All right. So there's several ways to de-risk the trade. One way is to move your stop up to break even. So now the stock comes back down to break even. You're not going to lose any money of principal. So that takes a lot of pressure off you, right? That takes a lot of the pressure off you. Another way that you can free roll is now if the stock goes up, if it goes up the amount of your stop, if you sell half of it, you have now financed your stop. So now you can allow the stop, the same stop. If it's 8%, stock runs up, you take off the amount that you have in risk, and you have now financed the risk. This is what we call financing risk. And once again, you have now de-risked the trade to where the trade is a free roll. The difference in this free roll scenario is that you now can allow the stock more room, but you've traded it off because you only have half a position size. So you can't have your cake and eat it too. If you want to have completely de-risk the trade and keep your same position size on, you move your stop up to break even. If you want to give it more room, and you think it's the beginning of a bull market, might have a tiger by the tail. So you want to have at least some position in it. You don't want to give the whole position up, and you don't want to choke it off. So now you can sell some and you can finance your stop. If the stock goes up, let's say your stop was 5% and it goes up much, much more, it's up 20, 30%. Well, now you only have to sell a smaller percentage to finance the stop. So again, the math, you can play around with the math, and it's just the concept that I want you to understand here. So here's a very simple, example. This was a stock here where I was buying MAXY a while back, way back actually in 2000. So again, stock breaks out here, right? We showed this before. It came from a little low cheat, came out of a cheat, runs up here, and now my original stop was down here. But now I move it to break even, right? Now I'm free rolling, right? I'm free rolling the trade. Now let me give you the example here of how I normally do it. What I normally do is I normally leave my stuff, and Mark, you could chime in. Maybe you have a tactic that you do sort of automatically. This is sort of something that I do kind of automatically, where I usually stick to my original stop until the stock does a couple things. One, I get a really decent gain, and I don't want to give all that gain back. Like I said, if I have a real big profit, I'm not going to let that come all the way back and turn into a loss. So that's one.